China's economic recovery seems to be coming to a screeching halt, with the Hang Seng index now officially entering a correction. After witnessing one of the strongest rallies in stock market history of more than 50%, the Hang Seng index is now down over 12% just over the past 1 month. Even Alibaba's earnings were extremely good, showing some rebound in online sales, but investors did not digest it very well, resulting in shares tumbling more than 5%. But I'd argue that all hope is not lost. There are some important metrics showing us what markets are trying to price in during this correction, which again will most likely be short-term headwinds only. And it seems like Goldman Sachs tends to agree with that opinion, as they see upside of more than 24% in the Hang Seng index by the end of this year. What are the chances of that happening, and how will the upcoming Congress in China affect markets' perception around Xi Jinping and the political tensions? Well, those questions are exactly what I want to address in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, let's understand what Goldman Sachs sees as the investment opportunity of a lifetime inside China. The main argument right now is the idea that China is going from a phase of reopening to a recovery. Essentially, the rally we saw in stocks were basically a relief rally, showing us how markets are trying to price ahead of time the growth you would see from the Chinese reopening. And as a matter of fact, that was well worth it, because China is seeing a rapid decline in COVID cases, and most cities within the country are officially open back for tourism after being closed for more than 2.5 years. If you ask me, that is a lot of growth and a lot of spending power waiting to be spent on China's tourism business, which in turn will spice up demand for small businesses and even big tech. One of the big reasons of the renewed interest around China is from the idea that it is actually leading the US in economic growth. Whereas the US right now is seeing its economic tightening phase, China is going to go into a loosening phase with lower interest rates to reach their 5.5% GDP growth target for the year. The recent PMI index released by the Chinese government showed us a very good sign of normalization in consumption levels from the average Chinese consumer, which obviously was the main concern for not investing in Chinese companies for the past 2 years. And most importantly for stock market investors, it turns out that hedge funds in the European and US states have increased their exposure to Chinese equities, not decreased, which is obviously a big shift in play from what they've been doing for the past 3 years. And trust me, the differences are really stark. As you can see, Chinese equities as a percentage of prime book orders at Goldman Sachs have increased from 7.2% in the summer of 2022 to almost 13.1% as of February 2023. Not only that, but a lot of the concerns around China being dethroned as a massive exporter of technology and manufacturing services should stay at bay because of the recent data we've seen from auto export powerhouses. As you can see, China has overtaken South Korea and Germany as the biggest emerging market for auto exports. Not only are the Chinese manufacturing electric vehicles at a faster pace than any country on earth, but they're not exporting more than they're importing than they have ever done before. As you can see, the trajectory has shifted to the upside since 2020, and unlike a lot of these other countries, the trajectory has just been to the upside for the past decade. Exports are an important indicator of economic strength because they show signs of foreign investment confidence within the country. When foreign companies are using contract manufacturers within Shanghai or Beijing, they're propping up exports for the country, which obviously is typically more profitable for the Chinese government and the businesses than for the companies that are outsourcing their manufacturing to China. And let's be honest, you can't talk about a growth recovery without discussing the Chinese consumer, whose current financial position is the best that it has been since 2008. 9. The Chinese consumer is sitting on more than $2.5 trillion worth of savings that it can deploy immediately without taking on any leverage. This means that when US investors realize that growth is becoming a scarce asset in most companies that are profitable, they're likely going to rotate into Chinese businesses, whether it be Alibaba or Tencent. And for those that don't know, a big reason why China's stock market has always been a hit or miss is because mainland China folks don't actually invest in their own companies as much as we do here in the US. In the US, people have lots of 401ks, and investment banking is a very big theme within the country. But in China, most of these companies that are public are driven and supported by foreign investors in other parts of Asia, Europe, and obviously the US. The average mainland consumer in China sitting in Shanghai or Beijing most likely does not own any stocks on the market. But with the reacceleration of growth and loosening policy, mainland China folks are starting to reinvest their savings in Chinese equities. But obviously, despite all of this, markets in China are still on their way to a correction of more than 15%. What could be the reasoning behind this, and what are the catalysts we want to pay attention to understand the situation of the recovery? Well, folks, the number one catalyst I'm paying attention to next month is going to be the National Party Congress taking place in Beijing on March 5th. And guess what? This time we're actually expecting much more optimistic news than bearish news, unlike with Xi Jinping last year. As a matter of fact, the NPC is the most important economic event in China in over 1 decade. This is likely a big reason why investors are de-risking their assets going into this meeting, because they want to take profits on the insane gains they've seen on Chinese equities, and they want to wait on what's actually going to happen with the government. Not only is the government going to set new growth targets for 2023, but they're going to discuss new fiscal budgets and policy supports for recovery from the pandemic. This is important because this is going to be the first time we're going to hear about China's government budget since 2020, which is basically going to be a combination of loose economic policy as well as government incentives to kick off growth in the private sector. Alibaba's recent earnings report was a perfect example of how markets are still trying to time themselves ahead of this specific Congress because of the insane amount of uncertainty we have. Alibaba beat on both top line and bottom line estimates, yet the stock sold off more than 5%. But when you're seeing fear develop as fast as we are seeing over the past 1 month, it really makes you question what investors are trying to truly look at. And it's pretty clear that from my research, markets are trying to price in the worst ahead of this Chinese Economic Congress. Alibaba reported a record quarterly revenue along with record gross profit of more than $97.8 billion. Yet the stock price is trading at the same level it was back in December of 2021. Even gross margins and profit margins for the company have recovered to levels not seen since 2020, which clearly goes to show that the slower growth and destruction we saw in profits for the company are most definitely in the rearview mirror. Chinese mainland commerce only declined by 1% year over year, whereas international commerce accelerated by almost 18% to almost $3 billion. And as for whether or not the Hang Seng index can actually recover, well, as you can see, we have most definitely broken out of the major downtrend line that we've been seeing since almost the start of 2020. The current retracement of around 38% is nothing out of the ordinary, and we've definitely seen bigger price rejections in the past. The 50% level will kind of be the area where markets might start to rebound, which obviously also tends to coincide with the support level around 18,800. And as you can see, pullbacks after bottoming patterns always tend to be quite popular. We saw that happen in 2004 and also the massive rally we saw during the dot-com rush of 1998. And guess what? This is the fourth time we are testing this support trend line that we've been following for the past 30 years. And like I just showed you in this case for China, both the technicals and the fundamentals seem to be aligning for the upside, which is exactly why I continue to be an investor in the space and why I am buying the dip. But as usual, guys, that is just my take on the situation. Let me know your thoughts down in the comment section below, and I thank you very much for watching.